Hey everyone! Welcome back to Wealth for You. If you love the idea of steady monthly income, but your CPF, SSBs, and REITs are already working hard for you, this video is for you. Because today, we're diving into one of the most talked about income funds in Singapore, the PIMCO Asia High Yield Bond Fund, SGD Hedged. This is a fund that targets around 5.9% yearly income in SGD, and it's managed by one of the world's biggest and most respected bond managers, PIMCO. Sounds exciting, right? But before you rush in, we'll break down what this fund really is, how it works, and most importantly, the risks you must understand before investing. Stay till the end, because I'll also share who this fund is actually suitable for, so you can decide if it fits your income strategy. And while you're here, please like this video so more Singaporeans can learn about income investing the right way, and subscribe to Wealth for You, where we help you become cash flow rich, not paper rich. Chapter 1. Bonds and Bond Funds Explained. Let's start simple. What exactly is a bond? A bond is basically a loan you give to a government or company. They borrow your money and pay you interest, called a coupon, every year. At the end of the bond's term, they return your original capital, your principal. For example, if you buy a $10,000 bond with a 5% coupon, you get $500 a year, and when it matures, you get your $10,000 back. Now, instead of buying single bonds, most investors prefer to buy bond funds. These are professionally managed portfolios holding hundreds of bonds across different countries and industries. Bond funds make it easy to earn regular interest income, diversify risk across many issuers, and let experts manage credit selection and duration. There are different kinds of bond funds. Government bond funds, which are lower risk and lower yield. Investment-grade corporate funds, which are moderate risk. And high-yield bond funds, which are higher risk and higher income. The PIMCO Asia High Yield Bond Fund sits firmly in that last category, designed to deliver higher income with higher risk to match. Chapter 2. Meet the PIMCO Asia High Yield Bond Fund. So what exactly is this fund that everyone's talking about? The PIMCO Asia High Yield Bond Fund is a UCITS-regulated fund based in Ireland, and it's recognized by the Monetary Authority of Singapore, meaning it's authorized for retail investors here in Singapore. You can invest through licensed financial advisors or trusted online platforms that distribute global mutual funds. Its goal is simple yet powerful: to achieve maximum total return from both income and capital growth by investing mainly in Asian high-yield bonds. In plain English, that means the fund looks for bonds that pay higher interest rates in exchange for taking on higher credit risk, aiming to deliver a blend of monthly income plus some price appreciation over time. It holds corporate bonds from across the region, countries like India, China, Macao, the Philippines, and Thailand, with a small allocation to developed market issuers such as the UK and US for diversification. Many of these bonds are rated below investment grade, so they pay higher coupons but also carry higher default risk. That's the trade-off for higher yield. The good news is, the fund is SGD hedged, which means even though most of its holdings are USD denominated, PIMCO actively manages the currency exposure so that your income and NAV remain stable in Singapore dollars, without wild swings from USD to SGD movements. Chapter 3. How much income can you expect? So, how much income can you really expect from this fund? And what drives it? As of 31st August 2025, the PIMCO Asia High Yield Bond Fund, SGD Hedged, has delivered an annualized distribution yield of about 5.9%, paid monthly. That means an investor who puts in 100,000 Singapore dollars could expect roughly $490 a month in distributions, before fees, a tidy stream of cash flow in Singapore dollars. Now, what's happening inside the portfolio? According to PIMCO's own fact sheet, The fund's bonds have an average coupon of 5.73%, a yield to maturity of 7.47%, and an effective duration of about 2.61 years. What does that tell us? A duration of 2.6 years means the fund sits in the short to medium-term range, so it's moderately sensitive to interest rate movements. If market rates move by 1%, the fund's price would typically move by roughly 2.5% in the opposite direction. That's how duration works. So if the U.S. Federal Reserve starts cutting rates, as many analysts anticipate, the value of the fund's existing higher coupon bonds could rise, giving investors not just steady income, but a modest capital lift as well. Of course, the size of that gain depends on how far and how fast rates actually fall, and on how credit markets behave across Asia. In short, this fund aims to give Singapore investors a blend of regular SGD income plus potential capital upside, all backed by a professionally managed basket of Asian high-yield bonds. Chapter 4. Diversification in Action. Now that we know what kind of income this fund can generate, let's take a closer look under the hood. What's actually inside this portfolio? The PIMCO Asia High Yield Bond Fund is built on one core principle: diversification. It doesn't rely on any single country or company for returns. In fact, it holds over 100 different issuers spread across Asia and beyond, each contributing a small piece to that monthly payout. Here's the geographic breakdown as of mid-2025. India takes the largest share at around 20%, followed by China at roughly 12%, Macao at 9%, the Philippines at about 5%, and Thailand at around 4%. There's also smaller exposure to countries like the UK and the US, which adds extra diversification and helps balance regional risks. In terms of industries, the top sectors include banks, utilities, real estate, and gaming. Essentially a mix of both essential services and cyclical businesses, carefully chosen to capture higher yields without putting too much weight on any one area. This broad spread means that if one issuer or sector faces trouble, it's unlikely to derail the entire portfolio. That's one of the biggest strengths of a professionally managed bond fund. It absorbs shocks through diversification. And behind it all is PIMCO's Asia Fixed Income team, led by Stephen Chang, a veteran with decades of experience navigating Asia's complex credit markets. His team combines global insights with local research, studying each issuer's fundamentals, monitoring macro conditions, and adjusting the portfolio actively to manage risk. In short, this isn't just a basket of random bonds. It's a carefully curated portfolio designed to deliver steady income through disciplined diversification. Chapter 5. What are the costs? Now, let's talk about something every investor should pay attention to: the costs. Because even the best-performing fund can disappoint if you don't understand how fees eat into returns. For most Singapore investors, the retail share class of the PIMCO Asia High Yield Bond Fund, that's the E-Class or M-Retail class, comes with an annual management fee of around 1.55%. That covers the fund's investment management, administration, and operating costs. There may also be a sales charge, up to 5%, depending on which platform or advisor you buy through. Some digital or fee-based advisors may waive this, so it's worth checking before you invest. Now, 1.55% a year might sound high compared to an ETF or SSB, but here's what you're really paying for. Active management. A professional team constantly monitoring Asia's credit markets, refinancing cycles, and issuer fundamentals. There's also diversification. Access to more than 100 bonds across multiple countries and industries. And there's SGD hedging, protection against currency swings between the US dollar and Singapore dollar. In other words, you're paying for expertise and stability, features that can be valuable in a volatile bond market. Of course, it's still important to weigh costs against returns. If the fund yields about 5.9% and fees take away roughly 1.5%, your net yield sits near 4.4% before any price gains or losses. That's still attractive compared to most bank deposits or government bonds, but it's good to be aware of how those numbers line up. So the takeaway here is simple. Fees are the cost of convenience and professional management. As long as you know what you're paying for and you're getting the value, then it can still make sense as part of your broader income strategy. Chapter 6. The key risks you must understand. Now, before you even think about investing, let's slow down and talk about the risks. Because no fund, not even one from PIMCO, is risk-free. Many people hear the word bond and think it's automatically safe. But the truth is, this is a high-yield bond fund, and that means higher income comes with higher risk. Let's break down the key ones in plain language. First, credit risk. The heart of high yield. When you invest in high-yield bonds, you're lending money to companies that don't have top-tier credit ratings. They pay higher interest because they're seen as a little riskier. If some of these companies face trouble, say they can't refinance their debt or they default, the fund's value or NAV can drop. That's the trade-off. You earn more interest, but you take on more business-specific risk. The good news is, PIMCO manages this actively by diversifying across more than 100 issuers, so no single default can hurt too much. Next, market and liquidity risk. When markets get nervous. Bond prices move when market sentiment changes. If investors suddenly demand higher yields, for example during a crisis or credit scare, bond prices fall temporarily. And in less liquid markets like Asian high yield, it can take longer to sell certain bonds at the desired price. So don't be surprised if you see NAV fluctuations from month to month. That's part of normal bond market behavior. Now, dividend out of capital risk. What few investors realize. This one's important. PIMCO is upfront that the fund may pay dividends from both income and capital. That means some months, if the bond income isn't enough to maintain a steady payout, the fund may top it up by returning part of your own invested capital. Your cash flow stays smooth, but the fund's NAV quietly decreases by that same amount. It's not bad. It's a design choice to provide stable income, but it's something every investor should understand before buying. Then, emerging market risk. Asia's opportunities and volatility. Because this fund invests mainly in developing Asian countries, India, China, the Philippines, and more, it faces emerging market risk. That includes political changes, currency movements, and sometimes even regulatory surprises. These can affect bond prices even if the underlying company remains sound. Finally, interest rate risk, the push and pull of rates. With an effective duration of about 2.6 years, the fund isn't extremely sensitive, but still, if global rates rise by 1%, its value could fall by roughly 2 to 3%. Conversely, if rates fall, the fund can gain a similar amount in price. So, while it's positioned in the short to medium range, it's not immune to interest rate changes, just more resilient than longer duration bond funds. In short, you're trading a bit of stability for higher yield, and that's fine, as long as you go in with eyes open. Diversification and professional management help, but market, credit, and payout risks still exist. So always size your position wisely. Maybe as part of your broader income strategy, not the whole thing. Chapter 7. How Fed rate cuts affect the fund. Now, let's talk about what everyone's waiting for, the Federal Reserve's next move. Because when the Fed cuts rates, it doesn't just move the U.S. market, it ripples across the world, including Asia's bond markets. For this fund, a rate-cutting cycle is usually a tailwind. Here's why. When interest rates fall, bond prices rise, because existing bonds with higher coupons become more valuable. That alone can lift the NAV of the fund. Next, Lower borrowing costs make it easier for Asian companies to refinance their debt, reducing the risk of default. That's good news for investors in high-yield bonds. And finally, because this fund is SGD hedged, falling U.S. rates also tend to reduce the cost of currency hedging. In simple terms, it becomes cheaper for PIMCO to protect your SGD income, slightly boosting returns. So if the Fed begins trimming rates in the next few months in 2025, this fund could see a combination of steady monthly income and mild capital gains. Nothing guaranteed, of course, but historically, rate cut cycles have tended to support bond performance, especially those with moderate duration like this one. Chapter 8. Who is this fund suitable for? So, who exactly is this fund for? This isn't a short-term trade or a quick win, and it's definitely not capital guaranteed. It's designed for income-focused investors. People who want steady monthly payouts in SGD, but who also understand that returns can fluctuate along the way. If you already have safer assets, like CPF savings, Singapore savings bonds, or money market funds, and you're now looking to boost your overall yield without going into full equity risk, then this could be a good complement to your portfolio. It suits investors who want consistent SGD income every month, can tolerate some NAV movement without panic, have a 3 to 5 year investment horizon, not 3 months, and appreciate professional management and diversification. It's less suitable for anyone who needs guaranteed capital or zero volatility, prefers only investment-grade bonds, or plans to redeem within a year. Think of it as an income enhancer, not your entire bond strategy. Maybe 5 to 10% of your portfolio, a satellite position that helps you stay cash flow rich, while the rest of your capital stays defensive. The key is to see it as part of a balanced income ecosystem, not a one-size-fits-all solution. Final thoughts. All right, let's wrap everything up. Here's the big picture for the PIMCO Asia High Yield Bond Fund. SGD hedged yield, around 5.9% per year, paid monthly. Potential total return, roughly 7 to 8% if rates fall and bond prices rise. Duration, about 2.6 years, meaning moderate interest rate sensitivity. Credit rating, average of BA. High yield, not investment grade. Currency, fully SGD hedged for local stability. Risks include credit defaults, dividend payments from capital, emerging market volatility, and NAV fluctuations. Fees, around 1.5% per year for retail classes. So yes, it's an attractive option for Singaporeans seeking income beyond REITs, CPF, or SSBs. But as always, higher yield comes with higher responsibility. Understand what you're buying, accept the risks, and invest within your comfort zone. At the end of the day, income investing isn't about chasing the highest number. It's about building sustainable cash flow that supports your life, year after year. And just to be clear, this video is for education and general information only. It is not financial advice or a buy or sell recommendation. All figures are from PIMCO's official fact sheet and prospectus, July to August 2025. Always read the fund documents, understand the risks and fees, and consult a licensed financial advisor before investing. If you found this video helpful, please give it a thumbs up so that more Singaporeans can learn how to build real sustainable income safely. And don't forget to subscribe to Wealth for You, where we focus on being cash flow rich, not paper rich. See you in the next video. Stay smart, stay invested, and stay free.